With everything happening in the Philippines right now, is MP2 still safe to invest in? Will MP2 be in trouble in the future? Should you stop investing and close your positions with MP2? Then those are fair questions and are really important ones, because the economic environment today is very different from what it was 10 years ago, when the Philippines was considered to be a rising tiger economy, whereas now Vietnam has leapfrogged the Philippines. Before we dive into the specific numbers and risks of any single investment, it's crucial to step back and understand the bigger picture. The economic landscape we're all navigating has shifted, and this context is key. The country is going through a prolonged period of uncertainty politically, economically, and socially. This isn't a short-term dip. The markets have been largely flat for more than a decade, offering little growth. The currency is weak, which erodes the purchasing power of our savings over time. Foreign investment, a key driver of economic vitality, is low and has been for some time. Consequently, confidence, both domestic and international, is understandably shaky. So people are asking a very valid question. If the country itself is on unstable ground, what happens to government-backed savings programs? Can we still consider them as reliable and secure as they were in the past? To answer that, we have to take a closer look at how this savings program actually works. So, what is the mechanism behind it? MP2 is essentially a voluntary savings facility that depends on the earnings of the main housing agency. Think of it as a capital preservation tool, designed for those with a more conservative risk appetite. The fund generates income by pooling money from member contributions, then lending it out through housing loans and investing in government securities. At least 70% of the fund's annual net income is then distributed to members as dividends. Because of this structure, it is not a high-risk investment. It is not a stock. It is not exposed to the same wild volatility as the stock market. Its returns are designed to be more predictable. But here's the nuance. It is still indirectly tied to the health of the Philippine economy. Housing demand, loan repayments, prevailing interest rates, and government finances, all of these macroeconomic factors directly influence the fund's returns. When the economy is stable and growing, MP2 tends to deliver strong tax-free dividends that historically outperform standard savings accounts. But when the broader economy slows down, the yields naturally follow suit, reflecting the tougher financial environment. So the next question becomes, are these returns still sustainable given the economic challenges today? When we cut through the noise, what do the facts tell us? Let's take a closer look at the underlying fundamentals. First, loan repayments remain strong, reflecting the financial health of its members. Second, the housing sector, a key driver of the fund's activity, is still active. And third, overseas Filipinos continue to contribute, providing a steady inflow of capital. The agency has consistently been profitable for many years and has a proven track record of paying dividends even in periods of economic weakness. Historically, it has managed risk conservatively, prioritizing stability over aggressive growth. And because the program invests primarily in low-risk government instruments, it's not suddenly going to collapse just because stocks are down or the political environment is shaky. This structure is designed for resilience. However, we also have to acknowledge the structural risks. The peso is weaker than ever, which increases inflationary pressure and affects long-term purchasing power. Government debt has risen sharply. Business investments are flowing into Vietnam, Thailand, Malaysia, and Indonesia, not into the Philippines. Tourism is declining relative to our neighbors. Manufacturing and exports have shifted abroad. Office vacancies remain high after POGOs left. This means the long-term growth trajectory of the country is questionable. Not necessarily catastrophic, but definitely slower and more fragile than our ASEAN peers. And when a country's long-term growth weakens, government-backed savings vehicles become more conservative, meaning returns may shrink slowly over time. So is MP2 still safe? In terms of capital preservation, the answer is yes. It remains one of the most stable peso-denominated instruments available for Filipinos. The risk of losing principal is extremely low, but is it still the best place to put your money? That depends on what you're comparing it with. From a global investment planner's perspective, here's the reality. If you compare the potential returns of MP2 with the bond market in the US, the yields abroad are much more attractive today. If you compare it with money market funds in stronger economies, many of them offer competitive or even higher yields with currencies that appreciate instead of depreciate. If you compare it with the S&P 500 or global ETFs, the growth potential is much higher outside. The trade-off is simple. MP2 is safe, but it is tied to a weakening currency and a stagnant local market. Foreign assets may carry more market risk, but they benefit from strong economies, global companies, and appreciating currencies. So what does this mean for someone investing today? If your priority is absolute safety and you want your money to stay in pesos, then yes, MP2 still makes sense. It is safer than most local financial instruments and offers predictable returns. But if you are thinking long term, if you want protection from currency depreciation, if you want exposure to markets that are actually growing, if you want to benefit from global companies instead of relying solely on the domestic environment, then diversification outside the Philippines isn't just smart, it's necessary. This isn't about giving up on the Philippines. It's about being realistic. The world has changed, the region has changed, and the economic landscape here is not as competitive as it once was. Safe doesn't mean high returning. Safe doesn't mean future-proof. Safe simply means your principal is secure. For many Filipinos, the smartest approach today is a mix of both. Keep some pesos in MP2 for stability, but start building positions in stronger, more resilient markets overseas. Because if there's one thing the last decade has shown, it's that relying purely on local investments limits your growth, your protection, and your opportunities. And in an environment like this, with uncertainty, slow growth, and currency pressure, diversification is not optional anymore. In short, yes, MP2 is still safe, but the Philippines as an investment destination is becoming less attractive. And if you want financial security for yourself and for the next generation, you need to start looking beyond the borders of the country. Not out of fear, but out of strategy. The world is bigger, the opportunities are broader, and your money deserves to grow where the environment is strongest.